Welcome to the Bean Counter. I am your host, Julie Bonner. In this production, we are going to explore, at a high level, how to assess company financial information that resides on financial statements. As a reminder, we have the Bean Counter podcast, and we also have a corresponding YouTube channel. All links to the podcast and YouTube channel are on the website www.corebridge.com. That is spelled www.coeurbridge.com. For your learning style, you may need to utilize both of the channels to learn the material. Just use what suits you and your needs. In learning financial statement analysis, you need to know why you need to learn these techniques. One reason to learn this is to train yourself on what these numbers mean. It is one thing to listen to a CEO or financial person on the news interpret these numbers, but it is another thing entirely to understand these numbers yourself and to make up your own mind about them. Plus, the more you know about these numbers, when you do listen to supposed experts, your mind has a much better way of interpreting what you're hearing, and you will have a better sense of if you can trust the person based on your knowledge. Frankly, learning this information takes practice, using these strategies over and over, and the more you do it, the better at it you will get. Second, you want to empower yourself as an investor. The more that you can interpret financial information on your own, the better you are at being able to read information about a company you follow, and you can have a feel for if it is a good time to buy, hold, or sell the stock without a financial advisor. I have used financial advisors, but I make my own decisions about my money and how it is invested. Third, you should be empowered with this information as an employee of a for-profit company. Most of these techniques are not easily applied to nonprofits or other types of businesses that are based on budgets rather than a for-profit model. There have been many instances of businesses going out of business because of bad financial decisions, and you want to be watching for this while you are employed. The more you practice these strategies on companies you work for, you will be amazed at how you can cut through the hype that a CEO might tell you about the financial performance. If you can inform yourself, then your gut will know when it might be time to get out of a company before layoffs start happening, or you completely lose your retirement savings. Finally, at some point, you may want to go into business or already be in business and you want to expand. Some people start their entrepreneurial journey by purchasing an already existing business, and successful entrepreneurs may want to grow by purchasing another business. Either way, you want to be able to find the best opportunities. One of the best ways to do that is to learn how to assess financial performance through the strategies presented here. Now, how do we do this? There are several different ways to go about it. One thing you want to do is to understand the products and services of the company. Most companies are easy to understand. For example, we know that a coffee company sells coffee. However, if you have studied Enron and their collapse, you will find that people had a hard time understanding their products and services. Now, that is not why Enron collapsed, but if you have Amazon Prime, I highly recommend watching the documentary called The Smartest Guys in the Room. Pay close attention to why understanding products and services are so important. The bottom line is this: if you have a good understanding of the products and services, then the financial information will make more sense. Then the second thing you want to look for is information about when cash is received versus when revenue is recognized. There can be a big timing difference between these two events. I am going to create a deeper dive into these topics. This production is just an introduction to this idea. But in the deeper dive, I will go into many examples so that you know exactly what it is you are looking for. For now, just know that cash and revenue happen independently, and we want to find out what that time delay is and if cash is being received before or after revenue is recognized. Once you have a good understanding of the products and services and the timing of cash and revenue, then you can start looking at the financial ratios that will help you interpret the financial information in the financial statements. On the income statement, you will be examining profitability ratios. The two ratios I recommend are to examine the gross profit margin ratio and the net profit margin ratio. Then on the balance sheet, you can study liquidity ratios. Liquidity ratios tell us about the ability of the company to pay their bills in the short term. There are a couple of ratios to examine. One is the current ratio and another is the quick ratio. In addition, on the balance sheet, we can examine solvency ratios. Solvency ratios tell us about the ability for the company to continue to operate into the foreseeable future. There are a couple of ratios that will be important here. One is the debt to assets ratio, and the other is the equity to assets ratio. I will be producing a deeper dive into the exact calculations in another installment, using a couple of different companies so that you know exactly how to interpret these ratios and where to find the data. The cash flow statement tells us about the cash flow of the company. It will tell you how the company is generating and using cash. Plus, one of the good financial metrics you would want to examine is the free cash flow. That metric tells you the amount of cash that the company has on hand that has no demand on it to pay short-term or long-term bills. Then, using the income statement and the balance sheet together, you can analyze what are called activity or efficiency ratios. The ratios you would examine are the accounts receivable turnover, inventory turnover, and accounts payable turnover. These ratios look at how well the company is managing their working capital, or the cash that is being generated and used in the operations of the business. In addition, you can turn these ratios into a format that can be used in a cash conversion cycle. The cash conversion cycle gives you the ability to see how the accounts receivable, accounts payable, and inventory are being converted to cash in numbers of days. I will be producing a deeper dive into the exact calculations in another installment, using a couple of different companies so that you know exactly how to interpret these ratios and where to find the data. For now, just know that the cash flow analysis is crucial to a business and is part of why some companies have such high stock prices like Amazon and Google. All of these topics in this discussion need to have a deeper dive into how they work and how to interpret the results. So stay tuned for all the great detailed content that is coming for you to use. In closing, financial intelligence and how to interpret financial information is crucial to your success as an investor, employee, and a consumer. Be sure to practice this though. One thing I would recommend is to pick a company you like or work for, or a business you would like to open, and study it regularly, maybe every quarter. The more you understand how the company makes financial decisions, the better armed you are to come to your own conclusions about their performance. For example, I have studied Starbucks for years, and in future deep dives, I will use them as my example so that you can see how comfortable I have become with their data. I look forward to talking to you soon. This is your host, Julie Bonner. As a reminder, we have the Bean Counter podcast, and we also have a corresponding YouTube channel. All links to the podcast and YouTube channel are on the website www.corebridge.com. That is spelled www.coeurbridge.com. For your learning style, you may need to utilize both of the channels to learn the material. Just use what suits you and your needs.